The first bank run signal is already blinking, and it isn't T people lining up to pull cash. It's stress showing up in the market banks use to borrow against collateral. The headlines obsess over deposits because deposits are visible, but the system doesn't break where it's visible. It breaks where it's funded. And the earliest cracks show up in the plumbing nobody screenshots for social media. Overnight collateral funding, repo, the secured rates that sit underneath everything else. That's the part most people ignore. That's also the part that forces decisions before the public even senses danger. And if you stay with me to the end, you'll know exactly what to watch over the next week or two. What level matters? What would confirm this? What would weaken it? And the one detail that flips this from technical noise into a real stress signal. Here's the uncomfortable truth. Before depositors move, balance sheets move quietly, instantly. Banks, dealers, and large funds don't wait for a crowd to form at an ATM. They react to funding conditions, collateral availability, and the price of rolling risk overnight. And the moment that overnight roll gets even slightly more expensive or slightly less available, behavior changes. Not because anyone is panicking, because the math changes. And when the math changes, risk managers don't ask for permission. They cut, they hedge, they hoard liquidity, they step back from making markets. And that's where the real pressure starts. If you only know repo as a word you hear on financial TV, you're already at a disadvantage, because repo is not a niche corner of finance. Repo is the system's circulatory system. It's how a huge amount of treasuries are financed. It's how dealers fund inventory. It's how levered players keep positions alive. It's how cash gets transformed into collateral and collateral gets transformed back into cash every single day. The simplest version goes like this. One party needs cash and has high quality collateral, typically treasuries. The other party has cash and wants safe collateral. They do a transaction that looks like a sale and repurchase, effectively a secured loan. The interest rate on that transaction, what people shorthand as repo rates, is the price of secured funding. And the key word is secured. This is not someone begging for money with nothing to show for it. This is someone saying, here is the best collateral on earth, lend me cash against it. So when that market shows strain, it's not about weak credit. It's about tight balance sheets, constrained liquidity, and the system's ability to intermediate collateral smoothly. And that is a very different kind of alarm. Now zoom in on the part most people miss. The first bank run sign is in T, people leaving. It's banks and dealers paying up to stay liquid, even when they have collateral. That's the tell. Because if the collateral is pristine and the funding still gets weird, it means the constraint is not trust in the borrower. It's capacity in the system. It's balance sheet space. It's regulation. It's risk limits. It's the willingness to make markets at the margin. And when the system runs into a capacity constraint, it doesn't politely slow down. It snaps, but not in a dramatic way. In a mechanical way, the kind that forces selling, forces hedging, forces a widening of spreads, forces volatility. And volatility is how this run becomes visible to everyone else. So what's this market in the title? It's the secured funding complex that shows up in rates like SOFR and TGCR, the repo transactions behind them, and the backstops the central bank provides to keep that plumbing from freezing. People talk about the Fed like it's one lever. It's not one lever. It's a set of pipes and valves. And when one valve gets used heavily, it tells you something about pressure in the system, even if everything still looks calm on the surface. But that's not the part that matters. The next detail is what flips the whole setup. The hidden detail is this. Watch whether institutions are leaning on official repo backstops, not whether depositors are posting angry videos. When private funding is smooth, nobody needs a backstop. When private funding is just a little tight at the edges, month-end, quarter-end, year-end, you may see backstops get used for convenience. And when usage goes from occasional to notable, you're looking at a change in the system's willingness or ability to intermediate collateral. That matters because it is the exact mechanism that can turn a normal calendar squeeze into something larger. And this isn't hypothetical. Recently, the Fed's standing repo facility saw record usage around a reporting date. That's a real-world print of this hidden dynamic. Stress doesn't have to look like panic to be stress. It can look like normal operations, while the system is quietly paying up for liquidity. And before you think this is just an academic plumbing lecture, let's ground it in the right now. Secured overnight rates like SAR have been sitting around the mid 3% area recently, reflecting the general level of policy rates and abundant front-end anchoring. On a normal day, that sounds boring. That's the trap. Because the important story isn't the level on a calm day. It's the behavior when liquidity thins. It's the jumpiness around calendar pressure points. It ends the way spreads behave when everyone tries to do the same thing at the same time. Because if this one level breaks, the math changes. Here's how that math works in the real world. Banks and dealers are not just lenders. They are balance sheet managers. A dealer that finances treasuries through repo is effectively running an inventory business. Inventory has a cost. That cost is funding. Funding depends on collateral terms, haircuts, and the willingness of cash lenders to provide money against that collateral. When volatility rises, haircuts can rise. When balance sheets get constrained, dealers step back. When reporting dates approach, some participants reduce exposures to look cleaner. That reduces intermediation. And then the same amount of collateral needs to be financed through less capacity. Rates can jump. Availability can tighten. That tightness forces the next move. Levered players reduce risk, basis trades unwind, hedges get put on, and liquidity thins further. That feedback loop is not emotion. It's plumbing under stress. And once it starts, it creates the exact kind of price action that makes the public feel like something is happening, even though the origin was mechanical. Now, bring in the calendar trigger, because why now is not optional here. Year-end is a known stress test, not because everyone is suddenly scared, because everyone is suddenly measured. Reporting dates matter. Balance sheet ratios matter. Internal risk limits matter. Window dressing matters. And the simplest way to reduce risk on a reporting date is to shrink positions that consume balance sheet. Repo intermediation consumes balance sheet. Treasury inventory consumes balance sheet. Levered trades consume balance sheet. So around month end, quarter end, and especially year end, it's common to see the price of balance sheet space go up. That's when secured funding can tighten. That's when money market behavior can change. That's when seemingly small stresses can become visible. And that's where the real pressure starts. Now, here is a crucial point that keeps you from getting hypnotized by one rate print. There are different rates for different slices of the same plumbing. SOFR is a broad measure of overnight secured funding transactions. TGCR is another secured rate based on Treasury general collateral repos, cleared through a major clearing bank. These rates tend to move with policy expectations, but their microbehavior can reflect the real-time availability of collateral and balance sheet willingness. The nuance matters because the system has shifted over time from unsecured interbank lending towards secured funding and market-based intermediation. That means stress can show up in secured markets even when the old bank-run optics, deposit lines, are absent. The system evolved, the failure mode evolved with it, but that's not the part that matters. The next detail is what forces actions. Watch the buffers. The system has shock absorbers. One of them has been the Fed's overnight reverse repo facility, a place where cash can park at the Fed and earn a rate against collateral effectively provided by the central bank. When that facility is large, it's like a reservoir of cash that can, under the right conditions, flow back into markets and soften spikes. When it's small, there's less readily available slack in that particular channel. Recently, usage has been far smaller than the huge peaks of prior years. That doesn't automatically mean danger. It means one cushion is thinner. And when cushions are thinner, small bumps can feel bigger. That's a mechanical reality, not a conspiracy. Now stack the next proof point, commercial paper. This is short-term unsecured funding used by large corporations and financial institutions. It's not the same as repo, but it's a complementary pulse check. When unsecured funding costs rise, or when issuance conditions tighten, it's a sign that liquidity is getting priced differently. You don't need a crisis headline for that. You just need marginal lenders to demand more compensation or to step back a little. Even small changes matter because short-term funding markets are about roll risk. You borrow today, and you have to borrow again tomorrow, and the next day, and the next. If the market starts charging you more or offering you less, you don't wait months to respond. You respond immediately. And that response ripples outward into risk assets, credit spreads, dealer liquidity, and volatility. But that's not the part that matters. The next detail flips it from rate trivia into system behavior. Here it is, money market funds. People talk about deposits as if the only run is cash leaving a bank. In reality, there's a quieter substitution that can drain banks without drama. Cash shifting into money market funds. Money market funds have grown enormous, and they can absorb cash that might otherwise sit in bank deposits. That matters because deposits are a key funding source for banks. If deposits shrink, or if depositors demand higher rates to stay, banks' funding costs rise and their incentives change. That doesn't require panic. It requires a competitive rate environment and a smarter cash manager. And when money market funds get more attractive, the run can look like a gradual drift until it suddenly isn't gradual anymore. Because if confidence wobbles, the drift becomes a sprint. But the sprint is preceded by plumbing signals. Always. Because institutions move first, and they move in markets. Now let us connect this to the force trying to suppress or ignore the move from the opening. In modern markets, suppression doesn't have to be a villain twisting a knob in a dark room. It can be incentives. It can be messaging. It can be a collective preference for stability. It can be institutions publicly encouraging the use of backstops to remove stigma. Think about that for 1 second. If the system is truly smooth, why does stigma matter? Stigma matters when the backstop is needed, but people hesitate to use it because it looks like weakness. If policymakers want the backstop used more freely, it S because they D rather the plumbing stay lubricated than have private market tightness cascade into visible stress. That's not sinister. It's risk management at the system level. And it tells you the watchers are watching the right place. The pipes, not the posters. Now, to keep this finance credible, you need to understand what would actually turn plumbing stress into market pain. Here are the mechanics, cleanly, without fairy tales. First, balance sheet constraint. If dealers reduce repo intermediation, funding rates can rise and liquidity can thin. Second, volatility feedback. Higher volatility increases margin requirements and haircuts, raising the cost of leverage. Third, forced behavior. If leverage becomes too expensive or unavailable, positions unwind. Fourth, spread signals. The term structure and spreads start to scream before spot markets do. Fifth, institutional flows. Money market and collateral preferences shift, pulling liquidity away from risk. That's the sequence. It's not about one dramatic event. It's about a chain of incentives. And if you miss the early links, you only see the chain when it's already wrapped around price. Let's do a quick, simple calculation-style thought experiment, because pattern interrupts matter, and this is where viewers usually lose the plot. Suppose a levered player holds a large treasury position financed in repo at a rate near SOFR. If that repo cost rises by even 25 to 50 basis points around a reporting window, the daily carry changes. If their strategy is thin margin, like certain relative value trades, carry is the edge. When the edge shrinks or flips negative, they reduce size. Reducing size means selling or hedging. That selling can push yields, widen spreads, and change the hedging needs of others. At the same time, higher volatility increases margin requirements on futures and swaps, which forces more cash to be posted. More cash posted is less cash available. Less cash available is tighter liquidity. Tighter liquidity pushes funding rates. And we're back in the loop. The loop is the story. And that's where the real pressure starts. Now add another layer, the difference between trend signal and noise. A single day where SOFR prints a bit higher is not the end of the world. A single day where repo gets jumpy around a holiday or a settlement quirk is not a prophecy. The signal is persistence and spread behavior. The signal is repeated stress around calendar points combined with increased backstop usage combined with other pulses like commercial paper rates, firming or issuance conditions tightening, combined with money market fund flows, pulling cash out of banks, combined with thinner shock absorbers like a smaller reverse repo reservoir. You don't need all of these to flash red at once. You need enough of them to tell you the system is becoming less forgiving. Because in markets, less forgiving is where drawdowns are born. So what's the underappreciated metric you should treat like a canary? It's the combination of backstop usage and the behavior of secured funding spreads around reporting dates. In plain terms, are institutions paying up or reaching for official facilities because private funding is just a bit harder to get on acceptable terms? If yes, that's the early warning. Not because it guarantees it crash, but because it tells you the system's capacity is tightening. And tightening capacity is what turns normal volatility into weaponized volatility. Because when liquidity thins, price moves more for the same order. That's how narratives get built after the fact. The plumbing moved first, then price, then the story. Now, I'm going to say something that will keep you from getting played. If this thesis is correct, price can still whip around violently against you. That's not a disclaimer. That's the nature of constrained liquidity. You can be right on mechanism and still get hit by noise. The market will use volatility to shake out weak positioning. It will produce fake breakdowns, vicious reversals, and headlines that arrive exactly when liquidity is worst. That's why your job is to separate signal from sensation. Signal is persistent stress, repeated facility usage, consistent spread behavior, and a clear chain of cause and effect. Sensation is one bad day and a scary headline. Don't confuse them, because if you confuse them, you buy tops and sell bottoms like clockwork, and that's where the system feeds. Now let's talk about what the other side is forced to do, because this is where your edge actually comes from. When funding markets tighten, dealers don't stand there and hope. They reduce risk. They reduce balance sheet usage. They widen bid-ask spreads. They demand more compensation. They become more selective about what they intermediate. That means market depth falls. When depth falls, volatility rises. When volatility rises, margin demands rise. When margin demands rise, cash gets pulled from elsewhere. When cash gets pulled, the funding complex tightens further. It's a reflexive loop. And if you're a retail investor watching only price candles, it feels like chaos. If you're watching the plumbing, it feels like a script, not a conspiracy script, a mechanical script. Now bring in the macro driver layer, because you can't ignore rates, inflation expectations, and policy stance. Policy rates anchor the general level of overnight rates, but they don't guarantee smooth functioning. You can have a stable policy rate and unstable market microstructure. That's why the secured funding complex matters. It tells you about distribution, not just level. It tells you whether liquidity is available evenly or whether it's being rationed. Rationing is where stress lives. And in a world where the front end has been repriced higher over the past couple of years and the system has adapted, pockets of rationing can surface around settlement quirks, large treasury issuance shifts in government cash balances, and changes in reserve distribution. This is the boring stuff that moves everything. And that's why most people miss it. Let's stack the proof points cleanly, because trust comes from stacking, not from shouting. 1. Secured overnight rates have been sitting around the mid 3% area recently, but their behavior around thin liquidity windows is what matters. 2. A major official repo backstop saw record usage around a reporting date, a clear sign that private funding conditions can tighten enough that participants choose the backstop. 3. Money market fund assets are enormous and represent a steady gravitational pull on cash that might otherwise sit in bank deposits, changing bank funding dynamics quietly. 4. Commercial paper rates and conditions provide a complementary pulse check on short-term funding costs and risk appetite in unsecured markets. 5. The reverse repo facility, the System S cash reservoir, has been much smaller lately than in prior periods, implying a thinner cushion in that specific channel. 6. Policymakers have publicly discussed normalizing backstop usage and reducing stigma, which is only relevant if the backstop is expected to be used. None of these alone is the crisis. Together, they're a map of where pressure can build. And that's the part most people ignore until it's too late. Now, the counterpoint, because if you can't argue against yourself, you're not doing analysis, you're doing theater. A lot of this can be technical. Year-end always has quirks. Settlement can do weird things. One facility print can be an opportunistic use rather than desperation. Broad financial conditions can still be relatively loose by some indexes, even when pockets of funding show microstress. And the system has learned from past episodes. That's all true. The goal isn't to panic. The goal is to watch the right chessboard. Because even technical stress can trigger real price effects when leverage and liquidity are involved. Technicals are how big moves begin. And that's not the part that matters. The next detail is how you turn this into a practical roadmap. Here's the roadmap for the next week or two, and I'm going to give it to you as a 2-scenario lens, because that's how you stay sane in volatile markets. Scenario 1 is the controlled pullback and retest. In this scenario, year-end pressures create some jumpiness, maybe a couple of spikes, but the system digests it. Facility usage falls back. Secured rates behave, spreads calm, liquidity returns as reporting windows pass. If you see that, it's not a false alarm. It is the system doing what it's designed to do. Absorb calendar stress without cascading. The confirmation tells are simple. Backstop usage stays low after the window. SOFR. And related, secured rates trade smoothly relative to policy anchors. And there's no persistent widening in short-term funding spreads. Invalidation for the stress is building story would be exactly that. Calm, persistence of normal functioning, and no follow-through in complementary pulses like commercial paper conditions. Scenario 2 is the continuation stress scenario, the one that matters if you care about systemic risk and market volatility. In this scenario, the calendar trigger doesn't just create a bump, it reveals a constraint. Facility usage reappears meaningfully around multiple dates, not just one. Secured funding gets jumpy more often. Dealers remain less willing to intermediate. Liquidity stays thin. And you start seeing second-order effects. Risk assets become more sensitive to flows, intraday reversals get sharper, spreads widen, and volatility becomes the tax you pay for every trade. In that scenario, the bank run is not depositors lining up. It's institutions hoarding liquidity and reducing exposure because the funding cost of carrying risk rises. The confirmation tells here are also practical. Repeated reliance on backstops, persistently jumpy secured funding behavior around settlement and reporting points, tightening conditions in other short-term funding markets, and visible signs of reduced market depth. Bigger moves on smaller news, because if this one level breaks, the math changes. Now, let's talk levels. Because even in plumbing, levels exist. They're just not chart lines on a stock. The levels are spreads and thresholds. Watch secured funding rates relative to the effective policy anchor. If secured rates begin persistently trading rich or volatile, relative to where you would expect them given policy, that's a level. Watch the difference between different secured benchmarks. If they start diverging more than normal, that's a level. Watch backstop usage. If it returns repeatedly and at scale around multiple windows, that's a level. Watch money market dynamics. If cash keeps migrating toward government money funds and away from bank deposits or prime exposures, that's a level. Watch commercial paper. If rates firm and availability tightens, that's a level. These aren't sexy lines on a chart, but they are the lines the system respects, and that's where the real pressure starts. Here's what to watch next in plain language, without turning this into a spreadsheet lecture. First, watch official facility usage around the end of the week and into the next settlement-heavy window. If the backstop is quiet, that supports scenario 1. If it lights up again, scenario 2 gains weight. Second, watch the behavior of secured overnight rates around thin liquidity sessions. Do they stay calm, or do they snap higher on days when you'd expect smoothness? Third, watch whether headlines suddenly start explaining repo plumbing to the public. That's not a joke. When mainstream outlets begin educating on plumbing, it's usually because the plumbing is already relevant. Fourth, watch market depth and volatility in rates and credit. When plumbing tightens, the rates complex often shows it first, then credit, then equities. Fifth, watch the psychological theater. If the market starts producing dramatic daily swings with confusing narratives, that's exactly the environment where mechanical stress gets disguised as sentiment. Don't fall for it, but that's not the part that matters. The next detail is how you protect yourself from being emotionally harvested. This is your viewer psychology shield, and you need it because volatility is a weapon. If plumbing stress is building, price will not move in a clean line. It will spike and drop and retrace and spike again. That's how weak positioning gets cleared. Headlines will show up at the exact moment you're most vulnerable, after a sharp drop, when the brain wants certainty. The brain will demand a story. The market will sell you a story. Don't buy it. Use rules. One rule: you do not make big decisions off a single day S-funding print or a single scary headline. Another rule: you define what would confirm and what would invalidate before you get emotional. Another rule: you assume violent whipsaws are possible even if the mechanism is correct, so you size accordingly and avoid leverage that turns a temporary spike into a permanent mistake. The market loves forced sellers. Don't volunteer. Now, step back and see the whole picture, because this is what ties the title together. The traditional idea of a bank run is a crowd pulling deposits. The modern early warning version is institutions quietly pricing liquidity differently, shifting cash into money market vehicles, and leaning more heavily on secured funding channels and backstops when private intermediation gets tight. That's the run before the run. It's not dramatic, it's not cinematic, it's mechanical. And mechanical is more dangerous because it doesn't announce itself. By the time deposit lines form, the system has already repriced risk, already tightened credit, already thinned liquidity, already forced selling somewhere. Deposits are the late-stage symptom. Plumbing is the early-stage cause. That's the hidden detail that reframes the entire story. So where does this leave you? Right now, today, this week? It leaves you with a checklist and a mindset. Checklist: watch secured funding behavior around year-end windows. Watch any meaningful repeated backstop usage. Watch money market fund gravity on cash. Watch short-term unsecured funding conditions like commercial paper as a pulse. Watch the size and role of system buffers like reverse repo. And watch for signs that dealers are stepping back. Wider spreads, thinner depth, bigger price moves on smaller catalysts. Mindset: you're not here to panic. You're here to be early. You're here to watch incentives and mechanics, not vibes. You're here to understand that calm can be a mask when liquidity is being rationed under the surface. And if you want to stay ahead, you watch the plumbing, because by the time the crowd sees deposits, the positioning is already done. And here is the final revelation you take with you. The market that screams first is the one that funds everything else. If secured funding stays smooth, most storms stay contained. If secured funding gets jumpy and backstops become routine, the system is telling you capacity is tightening. Capacity tightening is the seed of volatility. Volatility is the tax, and the tax gets paid by anyone who mistakes noise for signal or signal for noise. So over the next week or two, don't watch the theater, watch the pipes. And if you were the kind of investor who wants to understand what is happening instead of being surprised by it, keep a note of what you're seeing in these plumbing tells and compare it with how price behaves, because that's how you build real conviction without becoming reckless. If you're in this community, you're not here for hot takes. You're here for mechanism-first reality. And that's exactly how you stay standing when the crowd starts running.